All right, let's jump right into this due diligence explainer on ASE technology. They're a totally critical yet kind of overlooked player in the semiconductor supply chain, and right now they are riding an absolute tidal wave of AI infrastructure demand. While the big name chip designers grab all the flashy headlines, the advanced packaging companies, the ones literally piecing these incredibly complex chips together, are the unsung heroes actually making this technological leap possible.
So here's the game plan for today. We're hitting 6 main areas. Riding the AI packaging wave, taking a snapshot of their Q1 2026 financials, how they're fueling growth with Leap, the heavy cost of that expansion, the big rivalry between ASE and Amcor, and finally, their valuation and future outlook. Let's get to it. Look at this number, 149.8%. That's how much ASE's stock has absolutely skyrocketed year to date, heavily outpacing the broader semiconductor industry. Just for some context, sure, the broader tech sector has done well recently, but a jump of this magnitude tells us the market is rapidly pricing in a massive fundamental shift in ASE's long-term earning power. Okay, part 1, riding the AI packaging wave. What exactly is the catalyst behind this insane market momentum?
Well, the hype is absolutely backed by hard numbers. They just reported a record-breaking Q2 revenue surge, jumping almost 27% year over year to hit over 191 billion new Taiwan dollars. And this isn't just a slight lucky beat. It's a structural step up in their baseline business, driven almost entirely by the unyielding demand for AI-related products that require highly complex assembly.
And this is where it gets really interesting. Management is essentially telling us that the crazy computing power needed for AI is totally rewriting the traditional rules of the semiconductor packaging industry. Historically, this industry saw peaks and valleys tied to consumer electronics launches, like, say, everyone buying new smartphones in the fall. But AI data center demand, it doesn't care about the holidays. It's a constant, relentless, year-round push for capacity, and that's stabilizing and elevating ASE's revenue floor.
Moving on to part 2, our Q1 2026 financial snapshot. We've seen the top-line hype, but how does that actually flow through the core business? Just look at this immense year-over-year growth. Q1 net income practically doubled from about 7.5 billion to over 14.1 billion new Taiwan dollars compared to Q1 of 2025. They're successfully taking that market demand and turning it straight into bottom-line profits, and their basic earnings per share correspondingly jumped 85% to 3.24 NT dollars. Honestly, this kind of operating leverage is exactly what you want to see during an expansion cycle.
And just so we're all on the exact same page, when we talk about that massive 173.6 billion net revenue figure, we're talking about true core sales. It strips out all the accounting noise and top-line deductions, so we're getting a really pristine look at actual baseline demand. Which brings us to EBITDA. They posted a very healthy Q1 EBITDA of 38.16 billion new Taiwan dollars. In a sector where you're constantly buying heavy hardware and dealing with massive depreciation, this is a great look at the raw cash the business is actually spinning off. Digging into the balance sheet, total assets grew nicely to over 957 billion NT dollars in Q1. But here's the kicker for investors. They actually improved their leverage profile, even while investing aggressively. You'll notice their total liabilities grew, sure, but their net debt to equity actually went down. By lowering that net debt-to-equity ratio from 0.46 down to 0.40, ASE is basically operating like a family aggressively paying down their mortgage. They're making themselves way more resilient to interest rate fluctuations and market shocks. In a capital-intensive space like semiconductor packaging, maintaining a conservative debt profile while simultaneously growing at this speed is a huge testament to their management team. All right, part 3, fueling growth with Leap. We know the financials are solid, so let's zero in on the specific tech actually driving this. When you break down their assembly, testing, and material revenue, or ATM for short, literally 49% of their business is now wrapped up in advanced packaging tech like flip chip, wafer-level packaging, and system-in-package. These are exactly the high-margin, ultra-complex services that top-tier AI chip designers are begging for. They aren't just putting cheap plastic around old chips anymore, right? They're intricately connecting multiple chiplets together to function as a single, incredibly powerful AI brain. And they aren't stopping there. Management is aggressively targeting the mass production of FOLP, that's fan-out, panel-level packaging, by late 2026. This is a direct strike at resolving the severe supply bottlenecks currently choking AI chip manufacturing. Panel-level packaging essentially lets them process way more chips at once compared to traditional round wafers, which is a massive throughput boost for their most desperate customers. But hey, staying on the bleeding edge of tech is definitely not cheap. That brings us to part 4, the heavy cost of expansion. To stay at the top, you literally have to spend like you're at the top. ASA is dropping a staggering $8.5 billion on capital expenditures just this year. That's up from $5.3 billion last year. They're launching 15 new fab and expansion projects, and that includes expanding their footprint in the US, like in California and Arizona, all to guarantee they don't hit capacity ceilings when demand surges, and they fully expect this elevated capex to continue well into 2027. So what we're looking at here is a massive strategic trade-off. They are totally willing to eat some short-term financial pain, higher borrowing, tighter free cash flow, and rapidly rising depreciation costs to absolutely lock down capacity for 2027. It's the price of solidifying an undeniable long-term competitive moat. They're playing the long game here for sure. Of course, ASE isn't the only player on the board. Let's move to part 5 and look at the ASE versus Amcor rivalry. Both are phenomenal companies, but how do they stack up right now? Head-to-head, ASE is really standing out. Not only do they have that jaw-dropping year-to-date stock return of almost 150% compared to Amcor's 99%, but ASE is actually offering a slightly cheaper forward valuation. They're trading at a 35.3 times forward PE versus Amcor's 37.1. And even better, ASE is projecting higher earnings growth for the year at 47.4%. The real takeaway here is that while both of these companies are riding the AI wave beautifully, ASE just seems to have the fundamental edge right now. They've got faster projected revenue growth, nearly 20% this year versus Amcor's 13%, and much larger exposure to those highly profitable advanced packaging techniques we talked about. Their factory utilization rates are scaling wonderfully, leading to meaningfully better long-term earnings expectations. Which brings us to our final section, Part 6, Valuation and Future Outlook. Let's wrap this up and see what lies ahead for ASE Technology. Wall Street is absolutely paying attention here. Analysts are incredibly bullish, slapping a Zacks #1 strong buy rating on the stock. This confidence is largely anchored by management's projection that their advanced packaging revenues will literally double from 2025 levels. Throw in their expanding U.S. footprint, perfectly aligning with the push for domestic supply chains, and a projected EPS growth of 73.2% for 2027, the horizon looks incredibly bright. Now, no due diligence is completely bulletproof without a quick look at governance. One minor risk factor to keep on your radar is that the chairman's daughter recently joins the board. Naturally, this has sparked succession rumors. While it isn't necessarily a bad thing, any upcoming transition in leadership at a company undergoing an $8.5 billion capital expansion is something that could seriously impact executive direction, so it's worth keeping a close eye on. So ultimately, you've got to weigh all this data together. You're balancing an eye-watering $8.5 billion capex bet and all the resulting depreciation against some seriously skyrocketing growth metrics. Is this temporary margin squeeze just the inevitable price of entry to become the ultimate AI infrastructure play on the market? Given their dominant moat in advanced packaging, it's absolutely a question every tech investor needs to be asking themselves right now.